Bitcoin is bleeding for 3 straight weeks. We've seen nothing but red, with prices plummeting down to the 60K region. Everyone is asking the same questions. Why is it crashing? Is the bull run now over? And most importantly, is this a buy the dip opportunity at 60K or sell the rally as prices seem to be getting squeezed to the upside? Welcome back to Best Prop for You. Today we are going exclusively into the institutional structure of this move. We are looking at the noise, but we are looking at the weekly chart to understand the why and where we could head next. So if you're managing a prop account, put your hands under your thighs. Do not press buy yet. We are sitting on a critical Fibonacci cluster. Let me show you. From the bottom of around 15K to the record peak, we are very close to the 61.8 Fibonacci extension, and also recalling up to the 50. Whereas from top to bottom and taking the last leg to the downside, we are looking at the 161.8 Fibonacci. In fact, I should have done that. And there we go, 78.6. And the cluster that we are looking is between the 50 Fibonacci extension and also the 50 Fibonacci retracement and the 61.8 Fibonacci extension of the leg to the downside. These means the 70K is still very important, regardless of the fact that we actually saw prices going back down to the 60K. So what is a likely move for the entire first quarter, perhaps even later down the road? First, let's address the crash. Technically, it was inevitable. Look at this structure. From a carbon handle that I could draw, that would be the cup, and that would be the handle. Yep. We've completed pretty much the measured move projection, the distance from the bottom of the cup to the lip of the cup. We completed that up here, okay? And apart from this traditional chart pattern, we've also faced a wedge pattern, or in Elliott wave terms, this is known as an ending diagonal pattern. And off we go. Now we are crashing lower. Wave 5 ended. In Elliott wave theory, this is a massive exhaustion signal. It screams that buyers are running on fumes. When a diagonal breaks, it doesn't just retrace. It typically reverses sharply to, well, a deep correction level, which could be the 61.8. And just for the records, this level currently sits at the 57K. Okay. So where are we now? We are currently like in this territory, sandwiched between heavy Fibonacci clusters, the 50 and the 61 retracement. Price wick down to the 60K, respecting the zone for now. And also don't forget, this is a highly active zone that we have had when we were forming the handle of this cup and handle. But here's a danger. This bounce we are seeing today, it looks suspicious. If this level fails, there is virtually no support until the 50K. That level is critical. It was the major bottom that we saw back in 2024. Okay, that's our level here. That's a very important level that we're dealing with. And as analysts, we don't want to guess. We want to prepare for scenarios. So right now, we're weighing two possibilities. Scenario number one, the ABC correction. This sees this corrective leg as an A, B, and C structure, which, based on the Fibonacci expansion that we've used just earlier, we could have actually ended that leg. Now, sometimes the wave C is similar to the wave A, which means that if we were to extend lower down, we again come exactly at 50K, which was the previous low that we've just mentioned earlier, that we actually bounced off of and went all the way to new highs after completing this handle button. So if we do see an acceleration to the upside and we manage to stay above 61.8, right, and the 70K, then the bull trend might resume. Scenario number two. This is a 5-wave impulse. This is a bearish case and it's much more likely. In fact, this scenario splits in two because you can still have 5 waves going down. Yeah. Without that necessarily meaning we're going to see this moving further lower. And I will explain why. If this is the first 5 wave to the downside, then supposedly we are now in wave 3. So we expect to see wave 4 and then 5. As long as prices remain below the 80K, that could still be the case. So 80K is very important in this particular case. So let's just go ahead and draw that level. 5 waves down could be that we have finalized that leg and the entire structure of the peak over here, it's an ABC flat button. This would mean that this is A and B and we finished. We're going to finish potentially that leg down here and off we go. The bullish run can start again, can resume, but it will be at a lower level. There is also the scenario 2B, which is a 5-wave leg, and we are still looking at this as a ending diagonal. And then what is expected to happen, we are expected to see a rise, but this would again be retest rejected. And then we would be looking for another wave, a 5-wave move to the downside, which is the most bearish and highly risked scenario of the 3, let's say, right? So this is the one we need to worry about. If the move down is actually a new wave 3, then this is what we're seeing currently now. It's just a dead cat bounce. A dead cat bounce means this is a trap and will likely rally weekly, fail, and then crash through 60K to target the 50K level next. Given the velocity of the drop, the dead cat bounce scenario is what we're guarding against. So let's go down on the 1-hour chart. We step away from the weekly and zoom into here to understand that we don't want to try a catch and falling knife, because this is a falling knife. Look, from 76K, how it went down all the way to the 60K. Okay, your drawdown limit cannot handle that volatility. Instead, we wait for conviction. Now, if you want to buy, you need to see a microstructure break to the upside on the 1-hour chart with high volume. Okay, this necessarily isn't a breakout. We want to see an initial leg and we want to see a pullback and then the breakout of this peak. For now, we have broken above the 66.80, and that is, I would say, a flaw that we can keep an eye on. If you want to sell, watch the rally. If price struggles to move up and starts rejecting off lower highs, even if we went up, let's say, to the 70K, yeah, we need to pay attention. If we see a rejection here, yeah, and then that could be an aggressive entry to short the dead cat bounce, targeting 60K and below, or another entry would be rejection coming below the 66,800, excuse me, and then would pretty much enter at this breakout level. Now, if the 1 hour chart becomes more messy from what it is now, because currently it looks kinda impulsive, do not trade. Preserving your capital is more important than guessing the bottom. So the market has shaken out the weak hands. Now we wait to see if the institutions step in at the Fibonacci cluster or if the floor falls out to 51K. Stay cautious, manage your risks, and let the structure guide you. For more exclusive analysis and to start your prop trading journey, visit bestprop4you.com. See you in the next breakdown.